All right, so we are now recording, and all right, so welcome everyone to April 2022, the Huddle session. We've got Forcastr here, and they're going to talk, finances and getting everyone's financials in order, to hopefully write some, get some the attention of investors and get some checks from investors. And that's the whole premise of the next hour. Going to let them kind of talk about their journey. They actually went through Forcastr. They went through a morning mentoring program. I don't know, it was maybe about a year and a half ago that they went through a morning mentoring program. They're based out of Louisville. They're now killing it down in Louisville, and I've continued to have conversations with them and just kind of track their journey as they have successes and have some wins there. So I'm going to go ahead and I'll let Logan and introduce himself from Forcastr. He's going to be the gentleman who's going to be presenting over the next hour or so, and certainly want to make this interactive. If you guys have questions, things come up that you don't understand, please use the chat feature, or feel free to just certainly jump in and make your question or point known throughout this session. So I'll go ahead and turn it over to Logan. And I don't know if Mitch is going to introduce himself as well, but that's the team from Forcastr that we've got today. So Logan, I'll go ahead and turn it over to you.
Appreciate it. Well, here, I'm going to go ahead and share my screen just to get us oriented here. And I want to start things off just by thanking everybody for coming to this. And hopefully I'm not too echoey. I'm in one of our phone booths that we have here down at Forcastr headquarters. So hopefully this isn't too annoying if you can hear my voice reverberating or whatever. But either way, super excited to be talking to all of you all about specifically what we're going to be focusing on today, which is how to use a financial model for fundraising. And this is a topic that's really near and dear to our hearts here at Forcastr, because whenever my co-founder Stephen and I originally raised money for our company, for Forcastr, we had hardly any traction at all, right? We had an idea and we had our backgrounds, we had our experience, but we just had ourselves, and we had a really great financial model that helped us tell the story of our business. And our model was a super incredible, super powerful tool for us because we were trying to de-risk investors' investment. And the best way to do that is to speak to them using their own language. And that's the language of finance. It's the language that investors tend to speak. And, we always say fundraising's hard work. No matter how you look at it, it's just going to be difficult. And there's no doubt about that. But there are tools that you can use that just help make fundraising a little bit easier, a little bit more straightforward. And a really good, well put together financial model is definitely one of those tools. And I think you'll see by the end of this presentation that you'll know that it's one of the most powerful tools that you have whenever it comes to fundraising. So I'm going to go ahead and jump in to the presentation now. I want to note that I give this presentation fairly often. It's not an hour's worth of content. Usually I've gotten through it in less than a half hour before, so we can just kind of gauge and see how long it takes. But there should be plenty of room here at the end of for Q&A as well. So before I get way too deep into the content, though, I do want to give you a really quick background on myself, just so you know who you're talking to. So I'm Logan Burchett. I'm co-founder, chief operating officer over at Forcastr. And I'm a finance guy through and through. I've been in finance for pretty much my entire career, although you can call it a fairly short career. I'm 31 years old, but my entire career that I've had, I have been in finance. And I started things off working at the Kentucky Pension Fund. I helped manage their stock portfolio for a number of years. And I eventually left to become a fractional CFO for dozens of venture-backed startups. It's really where I honed my craft. It's where I learned the ins and outs of financial modeling, and it's where I really learned how startups work. And that's ultimately what led me to starting Forcastr. And even more importantly, it's what led me to finding my co-founder, who you can see on the screen next to me, Stephen. So between the two of us, we built well over 200 financial models. Forcastr itself's got nearly 400 customers. So you can kind of tack onto that, we built, over, 5, close to 600 models, kind of like in aggregate in that way. And I'm a finance mentor for Gus, Techstars, New Chip, GSV, know the startup game really, really well, specifically when it comes to finance. And I'll note here, just to tack on, hopefully a little bit of credibility for, why you should listen to this stuff. So Forcastr, me and Steven, we've raised about $5 million into the company in aggregate so far. We're a team of 24 people. So this stuff really does work. This isn't just, lip service or anything like that. I mean, this is actually real heavy, tangible stuff that will actually really pay a lot of dividends once you start fundraising. So want to talk a little bit about Forcastr. If you're not familiar with Forcastr, it's an online software that helps founders build great financial models so that they can run their businesses better, make better decisions and get funded. And really the ultimate heart of what Forcastr is trying to do is we're just trying to make forecasting easier and more meaningful for founders and investors. And it's really just because we love forecasting, and you'll see kind of as I give this presentation, how powerful we think that forecasting can be, but we really hate Excel, which is kind of funny, right? We were professionals at Excel, and we were deemed experts in Excel by many people, but Excel's clunky, it's hard to learn, but above all, it's unstandardized. So that means that every financial model that you see from every founder is different. And that makes it super difficult to compare data or to automate anything. In Forcastr, we marry it up really well where every model is still going to be unique, but it's going to have a level of standardization that exists in our platform. So that way you can compare yourself to your cohorts, you can link up data sources. It just makes you holistically a lot smarter and more efficient. And then on top of that, we have a team of experts that are going to help you all the way through, from the initial build all the way through through any ongoing questions that you have or anything. So if you have, if you're interested in Forcastr, I don't know, Mitch, if you're able to send a link to applying for the beta through the chat, but if we can, then let's go ahead and do that. Mitch is also our, a growth manager here at Forcastr. He's going to be helping me out today, help field questions and all of that stuff. So, we'd love to chat with anybody and everyone who's interested in Forcastr. And yeah, I see that chat just went out. So yeah, if you guys are interested, please do apply for the beta. Okay, so I want to go over a very quick agenda. So I want to talk about the power of a financial model, and specifically how it's going to help you raise money and how it's going to help you run your business better. So like the really two key aspects of what a financial model is going to help you do. I also want to talk about how we want to use a financial model in our pitch deck, and then how we want to present it to investors. And then I eventually want to make our way into a very mini, mock investor meeting, just so you can see how this stuff works operationally. But before we get into all that, I do want to pose a question to the group of what exactly a financial model is. And it might seem like a very high level, like almost like an obvious question, but it's actually not super obvious. If you ask 100 different people, hey, what is a financial model? You're going to get 100 different answers, right? Because there's just a lot that goes into financial modeling, and there's a lot of things that financial modeling entails. So I just wanted to open up this, to the group. If we can get people off mute, if anybody wants to, be brave and offer up their definition, let's get some interactive chatting going here. What is a financial model, you guys?
I guess I'll give it a stab, Logan. It's this is Chris from OmniBoom, and so I would say a financial model is a way to really articulate your costs and your revenues together to determine, where you're at within your business. And then when you talk about a model, I think about in the future. And so like, what, based upon your past, what you would be expected to gain, like in some sort of fashion in the future based on certain aspects within your business, right? So being able to say, okay, based on our model, we have, 22 customers and it's costing this much. We expect to be able to do so much on that based on revenue generation. And then, from there, it would kind of get put into some sort of, percentages in the future. That's how I'd guess it.
Yeah, no, I mean, there's a lot to like about that definition. I heard about revenue costs, so giving you like kind of like two sides of the equation, how much money we making, how much money we spending. You talked a little bit about using historical data, to glean insights and to understand kind of what's happened in the past and how does that translate into what's going to happen in the future. So I think that, there's definitely a lot of merit to that definition. Has anybody else gotten one that they want to
You're
share?
being nice, aren't you?
A little bit, but just kidding.
This is Steve Wolf at Unveil. I'd say it's a story that you tell numerically to help other people understand how your business works, the drivers of costs, the drivers of revenue, and the value that you're creating.
Yep. I do love that, Steve. So I really like the storytelling aspect of that. You're using it as a communication tool because financial models are communication tools. That's one of the things that whenever I define run your business better, raise money easier, a lot of that raise money easier comes from communication and then showing strategy and all of that stuff. So definitely like that definition. The one criticism I'll have in that definition is, kind of ignores the operational aspect to an extent, using it to make decisions about your company and all of that. But the storytelling, I think you got that exactly right. I think you nailed it on the head. Anybody else?
I would add that it paints a picture for the future financial situation of your company, using assumptions. It's a depiction taking basically from an abstract situation to a real world scenario.
Love it. No, that's great. I think that's really good. Kind of gives you that future aspect using the word assumptions, which I like. You're kind of assuming certain things about your business. It's a very common word whenever it comes to financial modeling. So all good thoughts. I think that we got some good, working definitions here. And I'd like to share my definition, which I actually stole. So this isn't actually a definition that I came up with. It is coined by a fellow by the name of Troy Hinikoff. He's the former managing director at Techstars Chicago. We're a Techstars company, by the way, in case you didn't know that. We went through Techstars Anywhere. He came up with this genius analogy of what a financial model is. And I've been stealing it ever since, and with his permission, of course, but I'm going to go ahead and share it with you all. So if you're looking at the slides, right, the early days of car manufacturing looked a lot like what you're seeing here in these pictures, right? So you'd have these engineers and they would go and take a bunch of clay and then they would build out these full scale like clay models of these cars. And you can see this in this photo right here, right? They're making these full on whole cars out of clay. And they'd scope it down to like the very like nitty gritty, every detail is accounted for. And then they would have to go and actually use these replicas to build complete working prototypes, right? Actual working cars that had engines that could actually go. And then they'd have to pay some super brave person to get into these cars. And then they'd have to test these prototypes in real time. So you got these testers. They'd hop into these completely unproven machines and they'd have to take them for a spin around a track. And sometimes the cars worked fine. Sometimes everything was great and it all worked out awesome. And sometimes you'd have this car that would flip over and do a barrel roll whenever it's taking like a 90-degree turn, right? But you don't know how the car is going to react until you build it. You have to basically create an entire car just to see if your concept works. And a lot of times it didn't, and it was back to the drawing board. And you have to iterate over and over and over again. You'd have to spend millions of dollars, and eventually maybe you have a car, right? Maybe you don't, maybe you do, maybe you don't. And it's absolutely crazy by today's standards because you're wasting a ton of time and energy and just unnecessary resources building out these early models, and you're risking lives in the process. And this is just not how we do things anymore, right? Nowadays, cars are built out completely soup to nuts using software. So you can build a car that can be tested and designed in just minutes instead of months, right? And you can make a virtual car and you can put it on a virtual track and you can take a virtual 90-degree turn. And that way, if it flips over, it's not a big deal at all, right? Nobody's hurt. You tweak some components, you lower the center of gravity, whatever you do. I'm not an engineer, but you do what you need to try it again until you get it right. And the idea of doing a full-on prototype before any software testing is just completely laughable by today's standards. And we think that this is a great analogy for financial modeling, because in the exact same way, we can use technology to simulate our business, and we can run tests in minutes instead of years and months. And you can see what happens when you add a new product line, or you try that new marketing channel, or maybe you invest in a sales force or something like that. And then early on, you can even understand if your business is viable, or if you need to switch it up, switch up your entire business model, right? I mean, I tell the story all the time. I used to have clients come to me that they would project out that they'd be making, hundreds of millions of dollars in revenue, in 5-6 years. But then if you back into the math, you'd have to acquire like 9 billion customers or something like that to do that. You know what I mean? Like more people than are on the planet Earth. So you have to understand, all right, is my business even viable? And in doing that, you're seeing if your business can handle those sharp 90-degree turns. Like, is it gonna show well, or is it gonna flip over into a barrel roll? But in this way, if there's an issue, nobody gets hurt. You don't get hurt. Your investors don't get hurt. Your co-founders don't get hurt. And it gives you a chance to figure those things out and to optimize and change things way down before you actually operate on them. And it saves wasting a ton of time and money. So because of this, we think that a financial model is actually the most powerful tool in your arsenal as a business owner. And when it comes to fundraising, your model is going to answer a lot of really key questions. And I'm sure if folks on this call, I'm sure you all are, but I'm sure if you're fundraising, you've been asked these questions before, and probably multiple times. And I just threw a couple of them on the slide. I could literally populate the entire presentation with investor questions that models will answer. But some common ones here are like, how much money are you raising, and why are you raising that much, right? Founders usually have a really good answer for the first part of that question. Hey, I'm raising $1 million. Hey, I'm raising $500,000 or whatever. But a lot of times they're going to falter and fall apart on the second part, right? Why specifically that amount of money? Why do you need to raise that amount of money, right? So this is something that a financial model can help you answer. What are your uses of capital, right? Hopefully the sources are going to be the investor. It's really getting into like, how are you going to be using the cash? And investors may also want to be able to see what happens if you use debt maybe for a portion of your raise instead of equity or something like that. Who specifically are you planning to hire, and what impact does that have on burn? Most of our costs as startup founders are going to be our people. So you're going to want to make sure that you have a detailed hiring plan put together so that you can answer those types of questions, and you can really speak to the growth plan that you have for your company from a personnel perspective. How do you plan on growing the business? Super, super important question. And this is something where you're going to want to go in and understand each of the individual channels, how you're going to be growing, the metrics that you need to be using, all of that stuff. And, that's the type of stuff that's really going to de-risk the investment for the investors and make sure that they understand how you're going to be growing the company. And if your model's buttoned up, if you spent the time and really invested the energy in building a good financial model, you're going to have really good questions or really good answers to a lot of these questions. And that's going to take a lot of the risk away from these investors, right? If you can have a good answer for their concerns, it's gonna de-risk the investment quite a lot for them. Now, we get a lot of questions around when do you need to invest in a financial model, right? In our experience, having a great financial model at the seed stage is a separator between you and other startups. And we've had a couple of customers say that investors are committed on the spot after they presented their financial models. Really inspires confidence for the investors because they're not necessarily at the seed stage and below expecting you to have the world's greatest financial model, right? They don't expect you to have something super buttoned up, super, super early. So it's kind of a separator, before the seed stage and at the seed stage. At the Series A stage and above, though, it's completely table stakes. You've got to have it. It's something that, there's really no way around it. because they're going to need to go through due diligence on your financial model. They're going to need to be able to understand all of your assumptions and all of that. So our advice is to invest early, the time and energy into building a financial model. It's only going to pay dividends later on, and it's going to set you up really well out into the future. And for the purposes of this presentation, I'm going to go ahead and assume that everybody on the call has a great financial model. And if this isn't the case for you, please do apply to our beta, get one with Forcastr. And actually, Mitch, if you're able to send around a list of the templates resources, we have a bunch of downloadable templates that you can use completely free of charge, powered by Forcastr. But for the purposes of this, we're going to assume that you have a great financial model. And now we want to talk about how you're going to be talking about your financial model in the context of speaking with investors. Okay. So what I'm talking about on this slide, just to be completely clear, is an initial pitch meeting. This is like a first time meeting, maybe a second time meeting with an investor. And I want to talk about how to talk about your financial projections within the context of, a 10-slide pitch deck, a concise, really compact 10-slide pitch deck. Okay. So the key to showing projections in a deck like this is to keep it high level and not to get too deep in the weeds. And this is actually a sample. This is a screenshot of our financial projections that we used in our deck way back in our pre-seed round. We raised a $750,000 pre-seed round here in Louisville. And what you'll notice is, even though we're a finance company, a financial modeling company, we didn't put a ton of numbers on the page or go through all of our assumptions or get way too deep in the weeds like that. We just included a graph that shows that up and to the right trajectory, showing that we're kind of on the right curve. And then we threw a couple of large numbers like margins, run rate, customers, those types of things on the slide. And this slide wasn't to convince investors that we had the greatest financial model in the world. That's not what we were trying to do. We were really just trying to whet their appetite, right? We're trying to show them that, hey, this can be a really big business, and our assumptions that are powering this forecast aren't crazy. These are very, very reasonable assumptions. And you want to do what you need to do in order to convey that message and then move on. And graphs and big numbers are a really good way to do this. And the biggest reason that you're wanting to do this, you're wanting to keep it relatively high level, is because you're wanting to stay away from number fatigue and analysis paralysis. Because remember, this is just an initial pitch meeting. An initial pitch meeting is meant to tell people about your business, your team, your traction, that type of stuff. It's not meant to be a deep dive into the unit economics of your company. And if you focus too much on that too early, you're going to burn a lot of time, and you're going to be focusing the investor's attention on things that it doesn't make sense to focus on just yet, and it otherwise was meant to be like a relatively short pitch meeting. And if you spend a lot of time and effort and energy on your financial model, it's going to be really tempting to jump in and show it off, too early, right? And you can back up all of your growth logic. You can communicate your game plan well, all of that stuff. And trust me, I went through all that. I had a great financial model. I could withstand super high investor scrutiny, and I wanted to show it off. But you have to note that there's a sequencing of things, and there's going to be a time and a place for that. And the goal of that first meeting is just to get the next meeting where you can do a deep dive into the numbers and where you can show off all of that logic. So one of the things that we recommend doing is, you can include some materials. You can include some materials from your financial model into a more detailed appendix. So we like slides that showcase things like unit economics metrics, detailed 5-year projections, all of that stuff. So that way, just in case you're in a pitch meeting, an investor wants to dive in deeper into something specific like that, you can just flip to the appendix and address it in real time. And that way it shows that you prepared and that you've done your homework. But just try not to focus the meat of the presentation on the financial projections. It's just not something that you want to focus on too early. And I mentioned, you've got the pitch meeting that's meant to get you that next meeting that due diligence meeting where you really dig into the numbers and you spend a lot of time talking about your financial model. So now I want to talk about, all right, now once we've gotten to that next meeting, once we've gotten to the deep dive meeting, what does that look like whenever we're talking about our financial model? And there's really 3 time periods to look at. There's what you should do before the meeting, what you should do during the meeting, and what you should do after the meeting. So I'm going to break these down into these individually. And before the meeting happens, one really important point is we don't recommend that you send them your financial model. And this is something that we have, people have different opinions on. We actually feel the same way about investor presentations as well, like pitch decks. But it's something that we feel very strongly about, right? You don't want a model to live on its own. You need to control the narrative and you need to present the model to them in person or on a call. And this is going to do a bunch of things. So one, it's going to give you leverage to get that next meeting, right? If somebody looks at that finance slide that we just went over and is like, hey, I want to dig into that more, I want to understand your math and your logic, then that's great, but they need to do that with you in the room. They need to do that with you presenting to them. And it'll demonstrate your understanding of the model whenever you do present it. And whenever you show your understanding of the model, you're showing your understanding of your business. Because remember back to our car analogy, it's a simulation of your business, right? The 2 directly translate, right? So if I can show you that I know my model, I'm showing you that I know my business as well. But most importantly, it allows you to control the narrative. So when an investor first sees your model, it's human nature for anybody that sees something for the first time, they immediately start to form an opinion on it, right? You want to be there while that initial opinion is being formed. That way you can control how that opinion is being formed. It's super easy for an investor to get the wrong impression of a financial model whenever they don't have proper context. And like it or not, again, this is true for all humans. Once an impression is made, it's really, really hard to change it, even if the thing that's giving you pause is really explainable. So you need to be there and present your model. And when you're doing that, you need to be in control. And people are terrified of these investor meetings whenever it comes to financial modeling. People go into these meetings and they're ready for battle and they think that they need to defend their model against the big bad investor that wants to tear it to shreds. But you have the power to not let this happen. This is a working session. So this is a session where you and the investor are working together and you're using the tool, or you're using the model as a tool to analyze what you think is realistic for your business. So you can present, hey, this is what we think is realistic. And then you all can have a discussion about that. And they may have different opinions, and that's great. You can model them out and you can talk about them in real time. You can run scenarios and you can ask them about their opinions and show them that you value their input and their experience. And remember, this is a working session. So you're also showing the investor how well you can work together, which is a really important point. So you want to respond to their ideas. You want to offer some of your own. You want to present, but you also want to brainstorm. And if you do the time, if you spend the time and really learn the ins and outs of your financial model, this shouldn't be a scary meeting at all. And it's perfectly okay to say, hey, I don't know. Let me dig into that and get back to you if you get a really hard question from an investor. So want to be in control during the meeting. And then after the meeting, you're always going to want to follow up. And this is something that Techstars taught us really well. They said, play like a champion, nail the fundamentals, right? You want to follow up. You want to summarize what you talked about in an email, and then you want to include a copy of your financial model. And so if they asked about a specific scenario or something that you didn't get into during the meeting, now you can run that scenario. You can summarize the outcome and you can send them a version of the model with that scenario. And if they asked you a question that you didn't know the answer to, go and talk to mentors, go and talk to other folks, other founders, and then figure out the question and then you can respond to them in a more educated way. And us at Forcastr, we love answering really good questions from, tough investors. So, we have an open invite there to all of our customers. If they said something that prompted you to do further analysis in the model, tell them about it, show them, send them, a version of that analysis or whatever. It's a great way to earn brownie points. But generally what you're trying to do is you're just wanting to show them that the meeting was productive and that it meant a lot to you. Okay, so now what I'm going to want to do is I want to go through very quickly what a very high level investor meeting might look like. And I'm actually going to use Forcastr as an example. And I'm going to move this over, so hopefully this is a little bit easier. Okay, so if I am going through my financial model with an investor, there's a flow that I like to follow. There's kind of like an order of operations that I like to adhere to. And this is something that we coach a lot of our clients through and we've seen a lot of success with, right? So I usually like to think of it as I start by showing you what is possible, and then I go into telling you how I'm going to be executing on it. And then I end with why I'm talking to you or why I need, the cash, right? So in order to do this, what I like to do is I like to start on the income statement and I like to talk about revenue. I like to say, zoom out kind of towards the end. And I like to show you kind of how scalable our revenue becomes and how we're going to scale our company into profitability and how exciting the prospect of this business actually is, right? As startup founders, I'm sorry to say most of our companies today aren't very exciting. If you just assume that it doesn't grow or change in any way, shape, or form, most startup companies aren't super exciting today, right? Look at Forcastr. We're sitting at these numbers are actually, I'm happy to say we beat our forecast, but we're mid 60s in monthly recurring revenue and we're burning, $170,000 per month, right? Not super exciting. It's an unprofitable business. But what we're selling is the vision. We're selling what this vision is going to be one day. And that's really what we're focusing on. So start with the visions, show them what the company can be. And I like to do that by talking about revenue on the income statement. And then I say, okay, now that I've shown you, what's possible, where we're going, now I want to tell you specifically how we're going to be getting there. Okay. So this is where I start going into operationally, how are we going to capitalize on this vision? And it all starts with growth, right? It's one of the, it's the riskiest part of the company, arguably for most companies. So it's like, how specifically are you going to be growing? So we start with our growth plan and we talk about how we're going to be acquiring customers and how we think it's scalable. And we can talk through kind of all of that in the meeting. And so what we've done here at Forcastr is what we refer to as bottoms up financial modeling. And this is what we do for all of our clients. We identify the specific things, the specific areas in which we're going to be growing the business, and we model them out from the bottom up, right? This is very different than what a lot of people do, which is top-down financial modeling, right? Top-down financial modeling would be saying, this is $100 billion a year industry. We're going to get 1% of it. And so that's $1 billion a year, right? It's not a good way to build a financial model. It doesn't really tell you anything other than like, it's a big industry, which like, maybe that's interesting. Maybe it's like not that interesting. But that's one way that some people will do it. Another way people will build a financial model is they'll just grow revenue by 10% month over month. Again, not a great way to build a financial model. Doesn't tell you anything. It just tells you that compounded 10% over 60 months is a big number, which I think we all know. You don't need a financial model to tell you that. So we really like bottoms up financial modeling because this actually tells you stuff, right? It can tell you what you need to do in order to grow your business. So if I'm presenting this, I'm showing kind of our diversified customer acquisition funnels. And I can also show you what we believe are going to be the funnels that are going to be the most important for us. And for us, our biggest funnels are going to be, Techstars, other strategic networks, and blogs and referrals. Like those are really like the meat and potatoes of how we're going to be growing the company. And, one of the great things about bottoms up financial modeling is we can actually identify the metrics and set targets for the underlying metrics that are going to be building up to this forecast, right? So I can say, by the end of 2022 in December, we want to acquire 17 new customers, in the month of December from partnerships, other strategic networks. That's going to be a big growth channel for us. How are you going to get there? Okay, well, our target for number of partnerships is going to be 60. So we hope to get 60 partners up and referring and running by the end of the year, by December. So if we can keep, a lead per partner, even if that degrades down to 1.3, which by the way, it's, 1.42 roughly right now. If we can keep that like relatively in the ballpark of where it is today, and we can scale the number, that's going to get us, 77 beta applications. So, just shy of 80. That's going to get us 50 deals in HubSpot, and we think it can get us 17 new customers. So what you're doing is you're giving them a peek into your roadmap, your strategy of like, what are your individual goals? How are you going to be thinking about, growing this company, and what do you need to hit in order to hit these numbers, right? And this is logically a good way to de-risk things, because if I just show you a forecast that says we're going to hit $100 million in revenue, you might be inclined to just dismiss it right away. But if I can show you that same forecast, but then show you step by step how we're going to be getting there on a metric level, you might start to believe me a little bit more. You might start to be like, okay, well, this guy's thought through this. This isn't just like some arbitrary number that he's throwing up into a forecast. Like, these are actually like tangible metrics and things that he's going to be striving towards. So he's thought through his game plan. That's really, what we do for our clients is we help them tell that story. So we start with customer acquisition and growth, then we make our way down to revenue. And this is where we spend the bulk of our time, is really between customer acquisition and revenue, because those two are kind of hand in hand, right? It's two sides of the same coin. It's how are you growing, and then how are you monetizing is really where it is. And that's what most investors are the most interested in. So this is really just telling the story of your revenue formula. So it's going through and saying, for us, hey, we do annual subscriptions. We charge, in our case, we charge $2,000 a year, which by the way, I'll get to this here in a little bit, but everybody on this call is going to get a nice discount off of that if you choose to partner with Forcastr. But it allows you to say, hey, we've got these annual subscriptions. We can identify all of the underlying metrics that, are going to add up to our revenue formula. So we can talk about, churn rate, annual bookings, like all our, bookings, all of that stuff. It's all outlined here in our financial model. And then we can talk about any other ancillary revenue streams that we have. So in our case, we do some support revenue. We do some CFO services revenue, so it just gives you a chance to talk about how our revenue is structured, the diversification of our revenue streams, all of that stuff. So focus a lot of time on customer acquisition and revenue, just to give you a sense of the growth of the company. And then we go into, all right, now these are the people that are going to execute on this vision, right? If we're going to grow customers, and if we're going to grow revenue in the way that we just described it, we're going to need a team of, talented people that are going to help us with that. So then we go into the people section. So this is where you can outline when you're hiring people, how much you're paying people. You can even throw in like annual salary increases and things like that, modeled hires. But the general theme of this page is to say, now that I've shown you the vision, I'm going to tell you about the team that's going to be executing on the vision, right? A lot of times what I'll focus on this page is who else we need, right? If I'm talking to an investor, who else do we need to bring on to the team to make sure that we can properly execute on the vision, to de-risk it for everyone, right? That's really what we try to focus on the people page, on the headcount page. I usually don't spend a ton of time on expenses, just because most of our expenses are our people, and that's true for the vast majority of startups out there. But we do like to touch on anything else that we're spending money on. Like in our case, we spend a decent amount on sales and marketing, commissions for our salespeople, all of that stuff. So I'll touch on expenses, and if there's anything I need to call out, then I'll do that. For us, it's pretty vanilla though. Our expenses is just kind of like SaaS plus commissions and things like that. So I usually don't spend a ton of time there. But then I'll talk about our assets. You can see this is cash for us. We burn cash and then we raise, and then we burn and then we raise, kind of the traditional startup path of just finding our way into profitability through fundraising and relying on investors. So this just inspires that confidence that, hey, we're going to be a good fiduciary of your money. We're going to be making sure that we don't run out of cash and that we're going to fundraise well in advance. And we have a good plan for how we're going to make sure that the company stays afloat while we build the ship into profitability. We'll touch on liabilities sometimes, but this isn't really a big area of focus for us. This is just what we owe people. In our case, we don't really have a ton of liabilities, so I usually don't spend a ton of time on this section, but I like to end up on equity. And I like to end here because this is why we're talking to the investor. This is, I'll usually say, I've talked about the vision. I've shown you our roadmap for how to get there. And I've talked you through the resources, the people, the expenses that we're going to need to make sure that we execute on this vision. Now I want to talk to you about how we're going to pay for all this, right? Like how is this all going to come into fruition from a capital standpoint? And that's why I'm talking to you, Mr. or Mrs. Investor, right? That's why it's important that we're having this conversation, because if all of this stuff that I just talked about is actually going to happen, we're going to need some capital in order to make it happen. And so in this case, you can see the capital plan that we've laid out. And some of this stuff's already happened, right? We've raised about $5 million in Forcastr. But, if we're saying theoretically, we may raise a $6 million Series A in, call it July of 2023. So it's just outlining that's our plan right now. So it just kind of shows you the amount that we're raising, when we're thinking about raising, just to give you a sense of the plan that we have for the company generally. And that's really it, right? Then we open it up for discussion and we talk about it, and I'd answer any questions that the investor may or may not have. But it's generally just going through, the major sections of the model, talking through strategy, and then opening it up for conversations from there. And now hopping back into my slide deck, this is really the last slide. So in the spirit of opening it up for conversations, I can kind of open it up here if anybody has any questions or wants to talk about anything. But I do want to offer everybody on the call a 25% discount off the first year of Forcastr. And I touched on this before, but Forcastr is ordinarily $2,000 a year. So we're going to knock $500 off that first year for folks that are on this webinar. So make it $1,500 for the first year. That is kind of a blend of SaaS and services in a way for year one. We're going to pair you up with a great financial analyst, somebody that is expert, level in venture finance. They're going to make sure that you get a great financial model and that you're trained on it. So for the first year, you're going to get access for the first 30 days to that analyst in a quasi unlimited capacity. Becomes self-serve after that, but we give you plenty of resources and still access to the analyst team if you have any ongoing questions or anything like that. So 25% off the first year. Encourage everybody here to apply. Any questions that we have? And Mitch, maybe I'll kick it to you. Do we have any in the chat right now that we want to jump in and answer?
No, I haven't seen any in chat. I just dropped the beta application in one more time if anyone doesn't reply. But yeah, if anyone has any questions, drop them in chat. Come off mute. Yeah.
I have a question.
Sure.
One of the hardest things for me to do, I am basically a recruiting as a service platform that is basically it's community software with referral software. So it's essentially what Give to Get is. Give to Get's a crowd recruitment and talent connection marketplace, enabling anyone to monetize their network by referring people into jobs at half the cost of recruiters. And so I'm trying to, and doing some research and trying to find some companies that were in the same stage, same talent acquisition space. I was trying to come up with assumptions, and it was just so hard to find assumptions that I could use for growth rate, churn rate, all these key assumptions that go into the model. So what are your comments on that?
Yeah, so I'm kind of laughing, first of all, because I love that concept for a company. I actually had an idea for a company I called Bounty Hunter that was like the exact same thing that you just described. I loved that idea. I thought that it made a ton of sense. So kudos to you for executing on it. That's awesome. And what your question is a very common question, right? If you're very early, it's really hard to get data for assumptions because you don't have any data. So everything is theoretical, right? But that's okay. Whenever we started Forcastr, everything was theoretical for us, but our financial model was our best asset whenever it came to raising money. Because what you can do, even though it's theoretical, is you can just outline what are you going to do to grow the company. And if I just asked you that right now, I'm sure that you would be able to articulate. You'd say, well, we're going to go into paid ads, or we're going to go into this network, or we're going to do this, or whatever it is. You can tell me. But what a financial model can do is just say, okay, take that narrative exactly as you just said it, and then let's just put it together using math. And then what do you think is reasonable? Maybe it's not perfect, but oh, well, you might say, I think I can get maybe 10 customers a month from this channel. So let's plug that in now. And it could be dead wrong. It could be completely wrong. You could get 10 times that or a tenth of that. And that's okay. You don't know. That's fine. But what's important is that you put it together and that you have the structure there. And then every month you update it. So you say, all right, this month has gone by. I said that I was going to get 10. How many did I get? Oh man, I only got 2. Okay, so I'm going to put in 2 here. Now I'm going to adjust it going forward. Next month, how many did I get this? Okay, we got 5 this month. Okay, cool. So now next month, all right, now I got 4. So I'm starting to, you know what I mean? So you've just got this really good framework for keeping it updated. And over time, the first draft of it is going to be so wrong, and that's okay. Everybody's is. It's always going to be wrong. That's just how it is. The important thing is stick with it, measure it, use your data. And I swear to you that if you let that go by for a couple of months, A, you're going to have good data, and B, you're going to understand your business better, and C, your investors are going to be blown away because you're going to have this great framework for not only measuring all of your data and all of your assumptions, but even using that data to forecast it going forward to show them how you're de-risking their investment. So it's a long way of saying, there's no silver bullet for giving you the perfect assumptions. The only silver bullet is set it up in the right way and then just measure and measure and measure. And then your assumptions become your own, but you know about them. And then it'll make you that much more powerful whenever you fundraise.
Okay.
Cool. Anything else?
Hey, this is Steve Wolf. Thanks for the presentation. I liked the focus that you put on the revenue side of it, and then the expandability of that section to kind of show customer acquisition. I think that's great guidance, and I appreciate you sharing that. If you could go back a slide or two, I didn't understand what you were doing with that line that said total equity value, how you were creating that. I haven't heard anybody use that term as a sort of metric of value in the way that you were. Could you just describe that a bit more?
Yeah, absolutely. It's actually a very simple metric, and all this is it's just saying it's the amount of equity that we've raised in the company. And if you're looking at financial statements, it's if you look at the equity line on your balance sheet, you have assets, liabilities, and equity. If you look at the equity line on your balance sheet, that's all this is calculating. So it's really people's eyes always go straight to that equity metric and equity value metric. In reality, it's not that sexy of a metric whenever it comes to just operational financial modeling, because all it's saying is how much money have you raised in aggregate, and then square that with the amount of money that your company has either made or lost in aggregate. So it's not meant to, opine on the enterprise value of your company. It's not meant to be any kind of a proxy evaluation or anything like that. It is strictly a financial mechanism on the balance sheet.
Thanks. That's what I was puzzling over. It's is this a clue into valuation? But you're really talking about the retained earnings line on the balance sheet. Do you have any perspective to share on how to think about valuations, both pre-revenue and early post?
Yeah, absolutely, I do. I got a bunch of opinions on that. I actually put together a YouTube video a while ago. And I don't even do YouTube, but I just like answered this question so much. I threw a video together, and it got a decent amount of traction, because what a lot of early stage companies do whenever it comes to determining a valuation, they focus too heavily on the valuation, first of all. So they try to put together like a complex formula, and they rely on this valuation that they've concocted in their heads. That's really not the way to go about fundraising, right? This is something that was nailed into our heads at Techstars. Is there was something that they said was incredibly important. Whenever you're fundraising, what you're wanting to do is you're going to want to build conviction around your idea, your team, and your business, regardless of valuation, right? Investors are going to be interested in your valuation, of course, because they're trying to make an investment, but just knock that off the table right away. We did this. I think we did a great job of this whenever we raised our pre-seed round specifically. But investors would say, what's your valuation, Logan? And we'd say, you know what? We don't know yet. We don't know what our valuation is yet. But honestly, let's not talk about that right now, because let's just put in our minds that we have come up with the valuation that you like and what I like, right? Let's assume that we come to that number. All right, if we do that, do you like the business? Would you invest in the business, right? And so we would do that all the time. And that way, and if they say yes, like, all right, assuming that you have a pre-money valuation that I like, I will invest in your company, assuming that I like the money, but I'm not committing unless I like that valuation. Well, guess what? That's a soft commitment, right? And you can do that over and over again and build up soft commitments. And once you've gotten enough soft commitments, you've got all of the leverage to go back to the most respected investor, a lead investor, to then set a valuation that is fair for them. And 99 times out of 100, regardless of what those pre-existing commitments were, once you set that valuation with that lead investor, everybody falls in the line. I've seen it time and time and time again. So our order of operations, whenever we raise, and we tell this to founders all the time, is take valuation off the table in early conversations. If they press you on it, just say, look, we will share a valuation with you. We have not set our valuation yet. We're just trying to get conviction around our idea, our business. Pretend you like the valuation. Would you invest? If so, how much? Great. Can I count you towards a soft commitment? Assuming the valuation is good, assuming you like it, can we count you towards a soft commitment? Great. Get as many of those as you can. Build up your round with, that's how you get momentum in your round, as you build them up. Then you go to that lead investor, and then you have that negotiation with them. And it is, by the way, a negotiation, right? You're not going to be able to back a ton up with metrics, because the metrics are working against you as a pre-revenue startup. It's hard to value something that doesn't exist. You don't have any revenue, right? So, don't focus on that. Focus on, how much of the company am I willing to sell? How much of the company are you willing to buy? Let's strike a deal here. I don't want to over dilute myself. That's the kind of conversation that you're having. It's less about monetary valuation than it is about striking a balance of dilution with how much money you're raising. And if you want kind of like very high level, like gut checks for it, usually in these early rounds, you're going to be selling between 20 and 25% of your company. Like 15 to 25 is usually kind of like the bound. It's like the range. So you can have that kind of, talk with your lead investor when the time comes to it. But
well, let me try and pin you down a little bit more here.
Sure.
So one of the reasons I'm interested in what you guys are developing there is we've kind of been working in more of a non-dilutive way. So government contracts and things like that are allowing us to build up our product. We've got a strategic partner already who I think will turn into a strategic acquirer. And so I'm thinking about your model more in an acquisition mode. We haven't generated enough revenue yet for me to say, we know all elements, the business risk is removed, the model works, everything's good. But we know that they're really excited about it. And so the question is, how do I build a defensible valuation for the company for acquisition purposes?
Yeah, that's a great question. And it's probably something that would take a little bit longer than 2 minutes for me to answer, but I'll give my 2 cents on it real quick. Is like, it is, and then even in an acquisition, it all comes down to negotiation just the same. It's like, what would you be willing to sell for? What would they be willing to buy for? And you're using the model to essentially give credit to your argument. You're obviously arguing for a high valuation. They're arguing for a low valuation. So one bit of like advice that I'll give is any kind of, hard discounted cash flow analysis, like really heady finance analysis that backs into this very specific number, that you're just asking for that to get torn apart, like that's just like really hard for theoretical numbers, right? This is theoretical math because it's all fictitious and in the future, but that doesn't make it useless. Far from it. I think it's still incredibly useful when it comes to negotiating, because you can say, look, this is what we think is going to happen. And this is why I want to argue for a high valuation for myself, because if I sell today, I'm giving up all of this upside up here, right? Like, this is my dream. This is my vision. And this is me showing you how I'm going to get there. So I'm going to need that higher number from you. And like, screw all this like DCF, like, heady, like finance calculations, because this is just like, what are we doing here? Let's just have a conversation, and I'm going to use my model to help with those negotiations. Hopefully that's helpful.
Yeah, thanks. Yeah, I appreciate it.
No problem. Well, I really appreciated this, you all. Thanks a ton for spending the time and letting me talk at you for a little bit. Hopefully it's helpful. I saw Mitch share the beta again, and then my email address. If anybody has any questions, wants to jump on the phone, open door policy. So just let me know. I'd be more than happy to chat with you guys.
Yeah, Logan and Mitch, thank you very much from Forcastr. Appreciate it. This is probably top 1 or 2 or 3 items that we get questions about, from our members here at the Alloy Growth Lab. So thank you very much for that. And I'll make sure to share this out with other members who couldn't make it. Thank you for the materials, Mitch. We got those as well. So again, appreciate it. And, really good insight into this. So thank you very much. And thanks everyone for jumping in. Appreciate it.
Appreciate it.
Thank you, guys.
All right,
Consider
thank
us
you.
your trusted resource. Yep.
All right,
Appreciate it,
we'll see
guys.
ya.
Bye, guys.
Bye.
See you guys.